Hi, everybody. Thank you very much for joining the HLC Equity Q1 market update. We appreciate all our investors who just joined and hopped on. And I'm going to go over some kind of macro level higher themes that we are looking at and that's top of mind at HLC Equity. And then we're going to get down into the nitty gritty of some of the details, both on our operational side and in terms of our acquisitions. So in general, we're looking at a challenging economic landscape, and we expect it to be a challenging economic landscape going forward. This is primarily due to structural and cyclical challenges. So slow economic growth is expected, if any, and this is as the central bank continues to fight inflation. As of last year, we had already planned on and we continue to operate under the assumption that we are going to have a higher for longer interest rate scenario. So that's just been basically the premise that we've been operating under. Another kind of concern going forward is the growing U.S. deficit and the management of public debt. Just one example is that the Congressional Budget Office has estimated that net interest spending will reach 3.1% of GDP in 2023, and that is a percentage point higher than the average between 1974 and 2023. So that's pretty staggering. If I get down into some of the micro level real estate themes that we're looking at, so we have a continued increase in operating costs, primarily, obviously real estate taxes and also insurance, but also just general inflationary expenses are also going up. There is an environment for decreasing rents, and we'll get into that and what some of the causes and the potential future looks like in terms of rents and softening of rents. And then you do have a surge in housing supply coming to market. And at the same time, opportunities are appearing, and a lot of that is as a result of some of this dislocation, which we're going to be discussing. So digging a little bit deeper into HLC Equities markets and where we operate. So if we look at Dallas remains one of the markets with the fastest growing submarkets in the USA. According to a 2022 and 2023 Census Bureau report that just came out, 13 of America's 15 most fast-growing U.S. cities were in the South, with 8 of them being in Texas. And so notable to HLC Equity investors, on this list there was Fort Worth and also Princeton, Texas, where a lot of HLC Equity investors have invested into our Southgate community. This growth has created a lot of supply because developers basically saw all the demand, and so it created an environment with a low interest rate environment. There became a lot of supply. But the population growth numbers suggest that this will be absorbed, that most of the supply should be absorbed within the next 1 to 3 years. The overall softening in the rental market points to a larger theme in today's multifamily market that's occurring, which is that tremendous rental demand mixed with low debt over the past decade brought total housing completions to multi-decade highs. And these projections, or a lot of these projects, they got completed in new multifamily starts are plunging now due to the high interest rate environment, which is likely to lead to a lack of supply over the next several years, which in turn is likely to push rental rates going higher as we go forward. And that's something that we are expecting. So meanwhile, CoStar recently reported that in markets like Dallas, Fort Worth, they project that rent declines have leveled out as strong demand returns to the market. And in the first quarter of 2024, renters filled 4,960 units in the DFW market, which is one of the highest since 2019. So supply hitting the market will get absorbed. That's what we are predicting. And increased insurance and property taxes, loan defaults create this perfect kind of storm to get properties at higher cap rates. So in the short term, we project that vacancy will remain elevated and rents will continue to be soft through 2024. However, due to the fact that we feel that this supply will get absorbed, we do see this trend changing and high rental demand mixed with a significant drop in supply to create an environment for strong multifamily investment performance. And in the short term, a mixture of softening rents, increased operating expenses, particularly real estate taxes and insurance, and some sellers needing to sell also due to the high interest rate environment, which is something that we are going to get into, which is potentially distressed sellers or sellers that simply they need to sell and they are going to sell at some price point. We view that the next 1.5 to 2 years is an ideal time to purchase well-positioned multifamily properties at a solid basis. So in many cases, these properties may be underperforming due to cyclical as opposed to secular reasons, but the underlying fundamentals of the assets are still strong, and that makes it a very attractive potential investment. HLC, we intend to pursue opportunities where we can buy properties at a good basis with prudent leverage. And we'll be able to implement our operational team's performance at the properties. And another thing is just patience for the market to come back around, assuming that you're buying good property, good basis, and well leveraged in a prudent manner. The next decade, we feel like, is for people who are willing to play the long game. It's not a time for short-term value-add plays. Time for long-term and strategic acquisitions at a solid basis in high-demand markets with vertically integrated operators who can outperform the market. So now in the webinar, you can hear about some of these higher-level trends along with some of the micro details on both what we are seeing in our portfolio from an operational standpoint and in terms of new acquisition opportunities. So thanks a lot for joining us, and I'm going to give you now to listen to Caesar and Dave. Thanks.